Hello and welcome to Degrees of Freedom, where I go over 5 slides in 15 minutes about the note industry to enlighten you about your own degrees of freedom. Hello, my name is Dr. Engerman, or Dr. E for short, and if this is a topic you'd like to know more about, hit that subscription button, hit that notification bell, and hit that like button. Today, we've got a great episode for you. A lot of people always ask me, how do you fund these deals? You've got to have a ton of money to probably start this, but that's not true. You just have to be a little creative. So today I'm going to talk to you about 5 things. The first is capital infusion. The second is personal funds. The third is capital raising and partnerships. The fourth is retirement funds and IRAs. And the fifth is seller finance. So without further ado, let's get to it. All right, so this is where we always begin. Although I am a doctor, a real PhD, the information presented on the Engerman Estates channel is for educational use and purposes only. Listen, I'm not an investment advisor. I'm not a financial strategist. I'm not a lawyer or a CPA. So if you need that type of professional assistance, please seek so elsewhere. Engerman Estates is not liable for any losses resulting from any action taken by a viewer based on the information presented or shared on this channel. Engerman Estates cannot promise earnings or returns based on historical reports or achieved by any party or affiliate in connection with the information presented. Listen, I'm going to start things off here. We're going to spend a little time on this slide, and we'll speed through some of the others because this is really important. I'm going to talk to you about what's happening with mortgage-backed securities and the Fed over here. Rocket Mortgage put out this statement back on February 27th this year, and they said that the Federal Reserve has committed to using every tool in a tool belt in order to support the economy and its recovery from COVID-19. One of the strategies the Fed has undertaken is to buy $40 million worth of mortgage-backed securities per month. I just want to stop there and pause. $40 million worth of mortgage-backed securities per month. Specifically, the Fed is buying what are known as agency MBSs. So mortgage-backed securities, we know, is another fancy term for notes. Okay, if the Fed is pouring in almost $500 million per year, $40 million per month in mortgage-backed securities, there has to be something there. Check this out. BlackRock and other really major main-time investors have poured in a ton of money into the residential space across the United States, up over 15% in the 2021 and quarter 4. And what we see here is really a large push by major hedge funds to engage in the mortgage-backed security space. So listen, as of 2021 and even before, we're starting to see a major move and a major push into this note space from the Fed and large hedge funds. So we know this is a popular space, and this is a really, really, really interesting space by the government and private investment firms. Okay, I can't stress that enough. So let's talk a little bit economy. All right, I've got buyer written here. I've got lender written here. I'm going to talk a little bit of economy or economics for you. When there is an economy that is moving, it is really moved based on transactions. Okay, transactions is considered the momentum. That's how we can consider it. And it's made up of buyers and sellers. And so we've got buyers or borrowers for us as note investors. And then we have lenders or creditors, and that's who we are. And so wherever there is spending, a buyer, that's another person's income. So whenever there is spending, follow me now, that's another person's income. And what we need to do is understand how transactions, a buyer and a lender, when they come together, they create a transaction, and that is the engine that really moves the economy around, large, small, and indifferent in the middle. And so what happens is, because of these transactions, we get something called the velocity of money. Bankers really understand this really well, and what that means is the speed at which the money is moving and changing hands. So the buyers and the sellers, right? The buyers and the sellers, the speed at which that is happening. And so bankers really understand this to an extent that they try to speed that up as fast as they can. As soon as they get an opportunity or a product or a inventory, they're trying to sell it really quickly because the speed of that transaction is going to engage them in a way and be in their favor. Okay, and that's what leads us to something called cash flow. And so I'll try this again. We have sellers. Okay, here we have buyers and we have sellers, and we create transactions which generate something called the velocity of money. Okay, or in other words, the velocity of money starts to evolve. And then what happens is we can kind of manage or see or even calculate something called cash flow. And the cash flow is how money is moving in and out of a system and flowing into your particular bucket. Okay, which is a deeper conversation. But what happens here with capital infusion is this doesn't work without capital infusion. And hence the reason why we have QM, right? We have this quantitative easing, okay, that is happening. So QE starts to happen. And so that's why money's getting pumped into the system so it can continue to generate this engine we call the economy through transactions, and it speeds up the velocity of money and generates more cash flow. Now, what we want to do is be on the right side of that cash flow, and this is where the note space is. This is what we want to do. We can actually purchase what's called cash flow, but it happens with capital infusion. Hopefully you followed that. Let's move on. So when we want to fund these deals, usually people are thinking about their own personal funds. And their own personal funds includes whatever's in their checking account, whatever's in their savings account, whatever they decide to borrow from someone else. Okay, they may be able to use their credit cards, or they may be able to liquidate their investments, and they may be able to get access to their HELOC funds, right, or home equity line of credit. And so this is what normal people would think is the only way that you can fund notes, but that's not true. And even if so, look at all of these different options here. We got checking accounts, saving accounts, borrowing money, credit cards, investments, and HELOCs. I mean, 2, 4, 6. Already I've dropped 6 ways that you can possibly try to fund a note deal, right? But check this out. That is not the only way that you can fund a deal, okay? We can use capital raising, all right? And this is that idea of borrowing to some extent. But with capital raising, we are raising funds, most likely after we've figured out a process or a system where we raise it with family and friends, possibly go to bank of family and friends or mom or pop, and we can generate a fund that will return to its investors some equity, right? Some investment, some capital gains of some kind. And based on your process or system, you might be able to carve off a slither that satisfies your investors enough, but also leaves enough in the tank for you to make a profit. And so sometimes these funds can be large, but they don't have to be. You can raise a fund as small as $100,000. You can raise a fund as small as $500,000, right? $1 million or more. Usually they are more. Sometimes they're in the millions. And these are these specific types of funds, you know, they can be regulated by the SEC. So that's where you kind of get into a little bit of tricky stuff there. And you definitely want to get lawyered up, all right? So that's part of the business where you want to get lawyered up depending on your state or county that you're operating in. The other way you can raise funds or get access to funds could be through a joint venture, what's called a joint venture. And so you know one person or two people that have access to funds, and you cut them a deal. You bring the work and the labor, and possibly they provide the funds. Or it could be a 50-50 split where you're bringing half of the funds, they're bringing half the funds, you bring half the work, they bring half the work. There's also opportunities where, again, you combine a fund and a joint venture all in the same space, and you get what's called general partners or GPs, or limited partners, LPs. But all of these things are still related to your relationships. They're all still tied to your relationships, and that's why I have that here. The note business is really built on the relationship, the strength of relationships you have with people. This is a people business. And if you're not a people person, we're going to have some trouble. And understanding that capital raising and partnering is merely a means of exchanging energy. Money is energy. So when we can understand and communicate how to share that energy, then we can have access to more and more funds. In particular, I want to talk to you a bit about this. I'm going to spend a little bit more time on this golden nugget, more than I would normally, because there's some information here that I don't want you to miss. Lots of really fascinating information here. So we have 401ks and 403bs, and these are our retirement funds. And I guarantee you the majority of the retirement funds that you have, probably 99% of them, are sitting in stocks and bonds. That's the equities market for the most part. But you have the equities market, you've got the cash, and you have these other things called alternative assets, okay? An alternative that you can have to stocks and bonds, which are your traditional, and that's Wall Street. So here's the deal. These alternative assets have many, 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 many forms. They come in the form of precious metals, commodities, licenses, patents, other businesses, real estate, and notes, of course. So these alternative assets really can help you diversify your portfolio in ways that Wall Street will never, ever, 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 ever tell you about. Because when they say you can diversify within your account, they are talking about mutual funds or ETF, which is another form of stocks, okay, or bonds, but not necessarily hard assets, physical precious metals, physical real estate, okay? And we know that notes are backed by real physical assets. That's why they're called mortgage-backed securities. So we can use a portion, it is legal for us to use a portion of our 401ks or our 403bs and things of this nature to invest in hard assets and alternative assets. You need to find a custodian, someone that would work with those assets for you and with you to do so, but they still exist out there. There are IRAs, which are tax-free vehicles, which are really neat and really great for you to use. And there are SDIRAs, which are self-directed. They give you even more flexibility. You can invest in things like crypto. Okay, you can invest in things, like I said, notes and other alternative assets quite fluidly with these self-directed IRAs, these truly self-directed IRAs. And they are alternative assets. So that's something you definitely want to look into to get access to funds that you have sitting there that are long-term. And what's really cool is you can roll these back into themselves, right? If you don't take them out. So you can still continue to grow them tax-free as you acquire real physical assets and real physical goods. All right, so seller finance is the other way. Seller finance is really interesting because you have to actually own the property first. And there's lots of different ways to do that. I've talked about what different types of notes exist in my previous episodes. And I actually will review those a little bit here, but you can generate notes. So for those landlords that have a portfolio of real estate, you have the opportunity to generate paper on top of your real estate that you own, which is a really powerful tool. It's also called owner financing. There are many different terms that people will set on these. They do 12-month balloon rates, and they use high rates depending on the type of tenant or owner you might have in there. If they are credit worthy, qualified mortgages are QM, they are regularly qualified. So that is a traditional note that you would have, high quality, that you would generate, and you can slap a 30-year on there or even a 40-year on there now, which is really nutty. You can, if you want, put in an LSO. That should say LSO, not LSA. So that's an LSO. Let me get that right. That should be O. All right, and that's a lease option. That is a lease option, okay, where they can lease to option. And basically, again, you may do a 2-year or 3-year, 5-year. I've seen 7-year lease options on there. And they are quite similar to leasing a car, right? You lease to own. So there's a short-term loan on it, and at the end of it, it's a balloon rate. The balloon rate is actually the full amount of the loan at the end of the day. But it allows the person to gain credit along the way. It incentivizes them so that they can be in good standing, good paying standard, and increase their credit. A CFD is another type of paper. It's a land contract. So that's a contract for deed, which is a really flexible type of paper that you can put on there. Here's what I would suggest. Again, I am not a lawyer or a CPA, When we are trying to do seller finance, get in touch with the lawyer in that local area, in that local facility, municipality, so that you can draw up the correct paper in that vicinity, okay? Because you can get into some sticky situations, and there are different laws in different states, in different legislative arenas. So that is all I have for today. My 15 minutes are up. Listen, if you liked this episode, please hit that like button, hit that subscribe button, hit that notification bell, and catch us next week on week 5 for our Degrees of Freedom. One family.